subscribe button in red. Before we begin, if you're looking for thoughtful, disciplined financial insights without the noise, I invite you to subscribe to this channel. This is where we approach markets with clarity, patience, and respect for your intelligence. Something fundamental has changed. For months, I've maintained a specific outlook on precious metals through the second quarter of this year. My analysis pointed toward one direction. My model suggested a particular path, and the probabilities seemed clearly weighted. Then the data shifted. Not the headlines, not the noise, not the predictions from talking heads who change their minds with every tick of the market. The actual underlying data that drives long-term price movements in gold and silver. This isn't about being wrong. It's about being responsive. It's about recognizing when the landscape transforms and having the discipline to reassess without ego getting in the way. Today, I'm walking you through exactly what changed, why it matters, and most importantly, what you should consider doing about it. Whether you currently hold precious metals or you're evaluating whether to enter these markets, this conversation is designed to give you clarity. We're going to examine the forces that have fundamentally altered the trajectory for May and beyond. We'll look at what existing holders should think about. We'll discuss what potential investors need to understand. And we'll identify the critical mistakes that could undermine your position regardless of which camp you're in. This isn't entertainment. This is about your financial well-being and the decisions you make with resources that took time and discipline to accumulate. So let's begin with what actually changed. 3 months ago, the picture seemed relatively straightforward. Central bank buying had shown signs of stabilization. The dollar appeared to be entering a period of modest strength based on rate differentials. Physical demand from Asia was robust, but not accelerating. And the technical patterns in both gold and silver suggested a consolidation phase through late spring. My May forecast anticipated range-bound movement with a slight bearish bias. Nothing dramatic, just a period of digestion after significant runs in both metals. Then, 3 significant developments unfolded. First, the Federal Reserve's language shifted in ways that weren't immediately obvious to casual observers. It wasn't about rate cuts. Everyone's focused on rate cuts. What changed was their explicit acknowledgement of liquidity concerns in the banking system and their willingness to adjust their balance sheet strategy. Why does this matter for precious metals? Because gold and silver don't primarily respond to interest rates in the simplistic way most people think. They respond to real rates, yes, but more importantly, they respond to monetary stability concerns and the credibility of fiat currency systems. When a central bank signals that financial stability might require more aggressive liquidity provision than previously indicated, that's a fundamental shift. It suggests the underlying stress in the system is greater than what's being publicly acknowledged. Second, we've seen an acceleration in geopolitical fragmentation that's affecting how central banks view reserve diversification. This isn't about any single conflict or tension point. It's about the pattern. Nations that previously maintained dollar reserves without question are now actively diversifying into gold at a pace that exceeds historical norms. The data from the World Gold Council shows this isn't a temporary phenomenon. It's structural. When central banks buy gold, they're making century-long decisions. They're not trading. They're repositioning their foundational reserves based on their assessment of the next 50 years, not the next 50 days. Third, the supply situation in silver specifically has become more constrained than my earlier models indicated. Silver is not just a monetary metal. It's an industrial metal with irreplaceable applications in solar panels, electronics, and emerging technologies. The supply deficit that we've been tracking has widened beyond initial projections, and more importantly, the above-ground inventories available for investment have drawn down faster than expected. These 3 factors converge to change the probabilities, not dramatically, not in a way that suggests chaos or immediate crisis, but enough that continuing to hold the previous forecast would have been intellectually dishonest. Markets reward those who can change their minds when conditions change. They punish those who fall in love with their own predictions. Let's establish context. Gold and silver don't move in isolation. They're embedded in a complex system of currencies, commodities, bonds, and equities. Understanding their current position requires understanding the broader environment. We're living through a period of monetary transition. For decades, the global financial system operated under certain assumptions. Dollar dominance was unquestioned. Central banks could manage economies primarily through interest rate policy. Inflation was conquered and would remain subdued. These weren't just assumptions. They were the foundation of investment strategy. Those foundations are being tested, not collapsing, not disappearing overnight, but being tested in ways that haven't been relevant since the 1970s. And when foundations are tested, people look for alternatives. They look for assets that have survived previous periods of monetary uncertainty. Gold has been money for 5,000 years, silver for almost as long. They didn't become valuable because governments decreed it. They became valuable because societies across continents and centuries independently recognized certain properties that made them useful as stores of value. This historical context matters because it explains why precious metals behave differently than other assets during certain periods. When stock markets are rising smoothly and inflation is stable and central banks appear competent, gold often looks boring. It generates no yield, it pays no dividend. It just sits there, maintaining purchasing power but not growing it dramatically. But when uncertainty increases, when monetary policy becomes unpredictable, when the value of paper currencies becomes questionable, gold becomes interesting again. Not because it's changed, but because the alternatives have become less reliable. We're in a phase where those alternatives are showing cracks. Bond markets are adjusting to a world where inflation isn't reliably dormant. Equity markets are grappling with valuations that depend on assumptions about future growth that may not materialize. Real estate in many markets has become disconnected from income fundamentals. This doesn't mean those assets are worthless. It means their risk profiles have changed and investors are reassessing. In that environment, precious metals serve a specific function. They're not about getting rich. They're about maintaining optionality. They're about having exposure to assets that don't rely on someone else's promise or someone else's competence. Markets are driven by two forces, fundamentals and psychology. The fundamentals in precious metals have improved, as I've outlined, but psychology is equally important, and it's shifting in ways that deserve attention. There's a growing recognition among professional investors that we're in a different regime than the one we experienced from 2008 to 2020. That era was defined by disinflationary pressure, central bank omnipotence, and the assumption that liquidity would always be available to solve any problem. Portfolio construction was relatively straightforward. Own growth stocks, own long-duration bonds, keep alternatives to a minimum. That playbook isn't working the same way anymore. Inflation proved more persistent than expected. Central banks proved less omnipotent than assumed. And the easy liquidity that solved previous crises is now itself part of the problem, having created distortions that can't be easily unwound. Professional investors are responding by rebuilding portfolios for a different world. That means more emphasis on real assets, more emphasis on inflation protection, more emphasis on non-correlated returns. Gold and silver fit directly into that framework. But here's what's important to understand. This isn't driven by fear or panic. It's driven by rational reassessment. The institutions buying gold now aren't doing it because they think the world is ending. They're doing it because they've concluded that a 0% allocation to monetary metals is no longer appropriate, given the changed risk environment. That's a profound shift. When portfolio allocation shifts happen at the institutional level, they create sustained demand that's very different from retail speculation. Retail investors trade based on emotion and momentum. Institutions rebalance based on strategic frameworks that change slowly. The psychological shift we're seeing now is strategic, not emotional. That makes it more durable. At the retail level, psychology is different but equally important. Many individual investors missed the moves in gold and silver over the past few years. They watched from the sidelines, either convinced that precious metals were outdated relics or simply overwhelmed by other opportunities that seemed more exciting. Now, those same investors are starting to pay attention, not because of hype, but because they're seeing the same data that institutions saw earlier. They're recognizing that their portfolios might be more fragile than they appear. This creates potential for a broader participation wave. But it also creates risks, because retail investors tend to enter markets at exactly the wrong time and with exactly the wrong approach. Understanding this psychology matters because it affects how you should think about your own positioning. If you already own gold or silver, your situation is fundamentally different from someone considering entry. You've already made the allocation decision. You've already taken the position. The question now isn't whether precious metals have a role in a portfolio. The question is whether your current position is appropriate given the changed outlook. Let me be direct. This is not permission to become complacent. One of the biggest mistakes precious metals investors make is treating gold and silver like religious artifacts rather than portfolio positions. They buy, and then they forget. They don't reassess. They don't rebalance. They just hold through everything, regardless of whether their original thesis remains valid. That's not discipline. That's inertia. My revised forecast suggests stronger potential for precious metals through the remainder of the year than I previously anticipated. That's good news if you're holding, but it's not a guarantee, and it doesn't mean your position doesn't need attention. Here's what you should be thinking about. First, do you understand why you own what you own? If you bought gold as portfolio insurance, as a hedge against monetary uncertainty, then the current environment validates that position. The insurance is more relevant now than it was when you bought it. Your position makes sense. If you bought gold or silver expecting a quick trade, expecting to flip it for profits in a few months, then you need to reassess whether you're approaching this correctly. Precious metals can be traded, but their primary value is strategic, not tactical. Know which approach you're taking because the decisions flow from that understanding. Second, is your position size still appropriate? Portfolio allocations shouldn't be static. As asset values change, as outlooks shift, as your personal circumstances evolve, your allocation should evolve with them. If precious metals have appreciated significantly and now represent a much larger portion of your portfolio than initially intended, you might need to trim. Not because the outlook is bearish, but because concentration risk has increased beyond what's prudent. Conversely, if precious metals remain a tiny fraction of your holdings and the outlook has improved, you might consider adding to bring your allocation in line with your conviction level. This isn't about market timing. It's about maintaining a disciplined approach to position sizing. Third, are you holding physical metal or are you holding paper proxies? This distinction matters more than many investors realize. Physical gold and silver in your possession serve a fundamentally different function than ETFs or futures contracts or mining stocks. Physical metal is about ultimate liquidity and counterparty-free ownership. Paper proxies are about convenience and tradability. Neither is wrong, but they're not interchangeable. If your goal is long-term wealth preservation and you're holding exclusively through ETFs, you're accepting counterparty risk that might not align with your original objective. If your goal is tactical positioning and you're holding exclusively physical metal with all the storage and transaction costs that entails, you're possibly making things harder than necessary. Match your holding structure to your objective. Fourth, are you emotionally prepared for volatility? The revised forecast suggests strength, but strength doesn't mean smooth sailing. Precious metals can be extremely volatile. 10% moves in a month aren't unusual. 20% drawdowns happen even within larger bull markets. If you'll panic and sell at the first significant pullback, then your position is too large, regardless of what any forecast says. The point of holding precious metals is to maintain conviction through volatility, not to trade in and out based on short-term moves. If you can't do that, reduce your position to a size where you can. Finally, are you continuing to accumulate if appropriate to your situation? If precious metals serve a strategic role in your portfolio and your financial situation allows for continued accumulation, then disciplined, regular purchases might make sense regardless of short-term price movements. This isn't about timing the market. It's about building a position systematically over time, allowing you to average into the position at various price levels. Dollar cost averaging isn't exciting. It doesn't generate the same satisfaction as calling a perfect bottom. But it works, and it removes the emotional burden of trying to time every purchase perfectly. For existing holders, the revised outlook should be validating, but it shouldn't create complacency. Stay engaged, stay disciplined, and make sure your position continues to serve its intended purpose in your broader financial plan. If you don't currently own precious metals and you're considering entry, the conversation is different. You're starting from zero. Every decision is forward-looking, and the temptation to make emotional, poorly timed choices is at its peak. Let me start with the most important point. Entering a market because you've seen a forecast that looks bullish is exactly the wrong reason to act. Forecasts change. Mine just did, as you've seen. If you buy gold or silver solely because someone told you it was going higher in May, what will you do if that forecast changes in June? Will you sell? Will you panic? Will you feel betrayed? That's not investing, that's following. The right reason to consider precious metals is strategic portfolio positioning based on your own assessment of risk, your own time horizon, and your own financial circumstances. Ask yourself, do I believe that the monetary environment has changed in ways that make traditional portfolio allocations more fragile? Do I believe that having exposure to hard assets makes sense given my assessment of future uncertainty? Do I have the temperament to hold through volatility? If the answer to those questions is yes, then precious metals might warrant consideration. If the answer is no, or if you're unsure, then don't buy regardless of what any forecast says. Assuming you've made the strategic decision that precious metals have a role, here's how to think about entry. First, there's no perfect time. You will not catch the bottom. You will not time it perfectly. Accepting this reality from the beginning removes an enormous psychological burden and allows you to act rationally. The goal isn't to buy at the absolute lowest price. The goal is to establish a position at a reasonable price within the context of a long-term hold. Looking at gold and silver from a multi-year perspective, trying to save a few percent on your entry point is far less important than actually getting into position at all. Second, consider staging your entry. Rather than committing everything at once, consider building your position over time. Split your intended allocation into thirds or quarters and establish positions over several months. This approach serves multiple purposes. It allows you to average into the position at different price levels. It prevents you from committing at what might turn out to be a temporary peak. It gives you time to get comfortable with the volatility and psychology of holding precious metals. Third, understand what you're buying and why. Physical bullion, ETFs, mining stocks, and futures contracts are all different exposures with different risk profiles. For most investors establishing a core strategic position, physical bullion or high-quality ETFs are the appropriate starting point. They provide direct exposure to the metal without the operational leverage and company-specific risks of mining stocks. Mining stocks can be valuable as a complementary position, offering leverage to metal prices and potential dividend income, but they're not a substitute for physical metal exposure. Futures and options are for sophisticated traders, not for strategic investors. If you're reading this and considering precious metals for the first time, derivatives are almost certainly not appropriate. Fourth, size your position appropriately from the start. A common recommendation for precious metals in a diversified portfolio is somewhere between 5% and 15% of total investable assets, with the exact allocation depending on your risk tolerance, age, and conviction level. If you're starting from zero, don't try to get to your target allocation immediately. Build into it over time as you become comfortable with the position. And be honest about your risk tolerance. If a 10% position in gold will keep you up at night, start with 3%. You can always add more as your comfort level increases. Fifth, prepare yourself mentally for what ownership will feel like. Precious metals will likely underperform during periods of strong economic growth and market optimism. You'll watch your friends' tech stocks double while your gold position sits there doing nothing. That's not a bug, that's a feature. The entire point of precious metals is that they serve a different function than growth assets. They're not supposed to outperform during the good times. They're supposed to preserve wealth during the difficult times. If you can't maintain conviction during periods of underperformance, you'll end up buying high during fear and selling low during complacency, which is the opposite of successful investing. For potential investors, the opportunity is real, but so are the risks of entering with the wrong mindset or approach. Don't let a revised forecast override your own strategic thinking, and don't let the fear of missing out cause you to abandon the disciplined approach that serves investors well in all markets. Regardless of whether you currently hold precious metals or you're considering entry, certain behavioral mistakes will undermine your success. These mistakes are common. I've seen them repeated countless times by otherwise intelligent investors. Recognizing them in advance gives you the best chance of avoiding them. Precious metals are volatile. A 5% move in a week is normal. A 15% move in a month happens regularly during larger trends. If you respond to every move with a trading decision, you'll destroy yourself with transaction costs and taxes while ensuring you miss the meaningful moves. The solution isn't to never trade, it's to have a clear framework that defines when adjustment is warranted versus when it's just noise. Write down your criteria before volatility arrives, then stick to them. The ability to buy precious metals on margin or through leveraged products creates the temptation to amplify your exposure beyond what's prudent. Leverage works both ways. It amplifies gains and losses. And in volatile assets like precious metals, leverage can force you out of positions at exactly the wrong time through margin calls and forced liquidations. If you can't sleep at night because you're worried about your position, you're over-leveraged. Period. Reduce your exposure to a level where you can maintain rational decision-making through volatility. Gold and silver are not get-rich-quick schemes. They're not going to double in 6 months and make you wealthy. They might double over several years. They might not. Their primary function is wealth preservation and portfolio diversification, not explosive growth. If you're buying precious metals expecting lottery ticket returns, you're setting yourself up for disappointment and poor decisions. Adjust your expectations to match reality. A 50% position in precious metals is not diversification, it's concentration. And concentration in any single asset class, no matter how attractive, creates fragility. Precious metals should be a meaningful but measured part of a diversified portfolio. They should not be your entire portfolio. Maintaining proper position, sizing requires discipline, especially when an asset has performed well and you're tempted to let it run. Rebalance when appropriate. Maintain diversification even when conviction is high. I'm sharing my revised outlook not so you'll blindly follow it, but so you can consider it within your own analytical framework. If you don't have your own framework, if you're just jumping from one expert's opinion to another, you'll always be one step behind, and you'll never develop the conviction necessary to hold through difficult periods. Use others' analysis as input, but develop your own thesis. Understand your own reasoning. Then you can adjust as conditions change without being dependent on anyone else's permission or guidance. Precious metals are often taxed as collectibles rather than capital assets in many jurisdictions, meaning higher tax rates on gains. If you're trading in and out frequently, you could be generating significant tax liabilities that undermine your net returns. Understand the tax treatment of precious metals in your jurisdiction before you establish positions. Factor those implications into your strategy. And consider holding structures that may offer tax advantages if appropriate to your situation. If you're buying physical metal, where will you store it? How will you secure it? What are the costs? What are the risks? If you haven't thought through these practical questions, you're not ready to buy physical precious metals. For some investors, professional storage solutions make sense. For others, ETFs eliminate the storage question entirely while accepting counterparty risk. Know which approach fits your situation before you commit. Every bull market in precious metals includes significant corrections. During the gold bull market from 2001 to 2011, there were multiple drawdowns of 20% or more. Those corrections felt terrible in real time. They looked like the end of the trend. Many investors sold, certain that they were avoiding further losses, only to watch the market recover and continue higher without them. Corrections are not reasons to panic. They're normal features of volatile assets. If you've sized your position appropriately and you maintain conviction in your strategic thesis, corrections are periods to endure, not to flee. Gold and silver are different assets with different characteristics. Gold is primarily monetary. Silver has both monetary and industrial demand. This means they don't always move together. Silver is more volatile. Silver has different supply and demand dynamics. Silver requires different position sizing. Treating them as interchangeable is a mistake. Understand each metal's specific characteristics and position them accordingly. The biggest mistake of all is forgetting why you established a position in the first place. If you bought precious metals as insurance against monetary instability, then they're doing their job simply by existing in your portfolio, regardless of short-term price movements. If you bought them as tactical trades, then you should have clear entry and exit criteria, and you should follow them without emotional attachment. Know your objective. Revisit it regularly. Make sure your actions align with that objective rather than with emotional reactions to market noise. Precious metals don't exist in a vacuum. Understanding their role requires understanding the broader market environment we're operating within. We're living through a period that future historians will likely identify as a major inflection point in global finance. The post-2008 playbook of endless central bank intervention, ultra-low interest rates, and the assumption that liquidity can solve any problem is being tested in ways that challenge its fundamental premises. Inflation returned with a force that wasn't supposed to be possible in the modern era. Central banks that positioned themselves as all-knowing and all-powerful struggled to respond effectively. Asset bubbles inflated by cheap money became obvious even to casual observers. Now we're in the aftermath of that regime, trying to navigate towards something new without knowing exactly what that new system will look like. This uncertainty is the context in which all investment decisions now occur. Traditional portfolio theory assumed that bonds and stocks were negatively correlated, meaning that when one fell, the other rose, providing natural diversification. That relationship broke down. Both fell together during recent periods, leaving traditionally diversified portfolios offering less protection than expected. Real estate, long considered a safe store of value, has become unaffordable in many markets, disconnected from income fundamentals, and potentially vulnerable to correction. Currency debasement through continued fiscal deficits and monetary accommodation remains a structural reality that no political party or administration seems willing or able to address. In this environment, what's an investor to do? The answer isn't to abandon traditional assets entirely. Stocks, bonds, and real estate will continue to play important roles in most portfolios. But the answer also isn't to pretend that nothing has changed and to maintain the exact same allocations that worked in the previous era. This is where precious metals fit into the picture. They're not replacing your entire portfolio. They're not the only answer. But they're serving a function that's becoming more relevant, providing exposure to assets that don't depend on the continued competence of central banks and the continued stability of fiat currency systems. Now, that doesn't mean those systems will collapse. It means that having some portion of your portfolio in assets that aren't vulnerable to those systems becoming less reliable is a rational risk management decision. Understanding this context prevents you from viewing precious metals in isolation. They're one component of a broader strategy to navigate an uncertain environment with resilience and flexibility. My revised forecast suggests stronger performance potential for precious metals through May than I previously anticipated. But let me be clear about what that means and what it doesn't mean. It means the probability distribution has shifted. The scenarios that favor precious metals have become more likely relative to the scenarios that don't. The risk-reward profile has improved. It doesn't mean gold and silver will go straight up. It doesn't mean there won't be volatility. It doesn't mean you should bet everything on one outcome. Markets don't move in straight lines. They oscillate. They experience false breakouts and fake reversals. They test your conviction and your patience. What's more important than any single month's performance is whether you're positioned appropriately for the multi-year environment we're entering. If the fundamental forces driving this revised outlook persist, and I believe they will, then the opportunity in precious metals extends far beyond May. We're potentially in the early stages of a longer-term structural shift that could play out over years, not months. That perspective should inform how you think about positioning. Short-term traders will try to capture every move, getting in and out based on technical signals and momentum. Some will succeed, most will fail, eroding their capital through transaction costs and mistimed decisions. Strategic investors will establish positions, size them appropriately, and hold through volatility, allowing the structural forces to work in their favor over time. Which approach you take depends on your skills, your temperament, and your time horizon. But for most people reading this, the The strategic approach is more appropriate and more likely to deliver positive outcomes. Looking beyond May, several factors will drive precious metals over the medium term. Central bank buying will likely continue as reserve diversification remains a strategic priority for many nations. This provides a baseline demand that's relatively insensitive to price. Physical demand from Asia, particularly from India and China, remains robust. These markets have cultural relationships with gold that span generations and provide consistent underlying demand. Industrial demand for silver continues to grow as solar panel installations increase and technology applications expand. This structural demand shift provides support distinct from monetary considerations. And most importantly, the monetary environment remains uncertain in ways that favor assets outside the traditional financial system. None of these factors guarantee performance. Markets can remain irrational or move contrary to fundamentals for extended periods, but they stack the probabilities in a particular direction. Here's something that doesn't get discussed enough in financial media. Uncertainty is not something to be conquered. It's something to be respected and navigated. Every forecast is wrong. Every model has limitations. Every analysis is based on incomplete information and assumptions that may not hold. My original May forecast was constructed carefully, using the best available information at the time. My revised forecast is constructed the same way with updated information. Both could end up being wrong. That's not a failure of analysis. That's the reality of operating in complex dynamic systems, with countless variables and participants. The question isn't how to eliminate uncertainty. The question is how to position yourself so that you can survive and thrive regardless of which uncertain outcome materializes. This is why position sizing matters more than forecast accuracy. This is why diversification remains essential, even when conviction is high. This is why maintaining liquidity and flexibility allows you to adapt as conditions change. The investors who survive and compound wealth over decades aren't the ones who make perfect predictions. They're the ones who position themselves to benefit from favorable outcomes while limiting damage from unfavorable ones. That discipline is more valuable than any forecast I could ever provide. It means holding precious metals as part of a broader portfolio strategy, not as your entire net worth. It means sizing positions so that being wrong doesn't destroy you. It means maintaining the emotional stability to act rationally when others are panicking. Most importantly, it means accepting that you don't need to be certain to act intelligently. You don't need to know exactly what gold will do in May. You need to understand the forces at work, assess the probabilities, and position yourself accordingly within a risk management framework that allows you to sleep at night. That's not exciting. It won't generate viral headlines. But it works. We've covered significant ground in this discussion. I've shared why my May forecast changed. I've walked through what existing holders should consider. I've outlined what potential investors need to understand, and I've highlighted the critical behavioral mistakes that undermine success regardless of your specific positioning. But the most important message has nothing to do with gold or silver specifically. It's this: financial success comes from preparation and discipline, not from prediction and luck. You don't need to know the future. You need to position yourself so that multiple potential futures work in your favor. You need to maintain the emotional stability to execute good strategies even when they're uncomfortable. The revised outlook for precious metals matters insofar as it informs your positioning decisions. But it doesn't change the fundamental principles of sound investing. Diversify intelligently. Size positions appropriately. Understand what you own and why you own it. Maintain emotional discipline through volatility. Rebalance when warranted. Think in years and decades, not days and weeks. These principles apply whether we're discussing precious metals, stocks, bonds, real estate, or any other asset class. They're timeless because they're rooted in human psychology and risk management rather than specific market conditions. As we move through May and beyond, conditions will continue to evolve. New information will emerge. Forecasts will need to be updated, including mine. Markets will experience volatility that tests your conviction. Through all of that, your job is to remain anchored to sound principles while staying flexible enough to adapt when conditions warrant. If you hold precious metals, continue to evaluate whether that position serves its intended purpose. If you're considering precious metals, make sure you're doing so for strategic reasons, with appropriate sizing and realistic expectations. Don't let anyone, including me, convince you to take actions that don't align with your own circumstances, risk tolerance, and financial goals. This is your financial life. These are your resources. The decisions are ultimately yours, and they should be made thoughtfully, not emotionally. What I can offer is perspective, analysis, and a framework for thinking through complex situations. But I can't and shouldn't make decisions for you. The fact that you're here, engaging with this content, thinking carefully about these questions, means you're taking your financial well-being seriously. That discipline will serve you far better than any single forecast or prediction. Markets will rise and fall, forecasts will change, economic conditions will evolve. Through all of it, The investors who maintain composure, discipline, and adherence to sound principles will position themselves for long-term success. That's not exciting, it's not dramatic, but it's real. And ultimately, real wealth isn't built through excitement and drama. It's built through consistency, patience, and the willingness to do what's rational even when it's not emotionally satisfying. As we close this discussion, remember that precious metals are a tool, not a religion. They serve a specific function in a portfolio. They respond to specific conditions. They require specific management approaches. Use them wisely if they fit your situation. Ignore them without guilt if they don't. But whatever you decide deliberately, strategically, and with full awareness of both the opportunities and the risks. The opportunity in May may be different than I originally forecasted. The long-term fundamentals may have shifted in ways that favor precious metals, but none of that matters if your approach is driven by emotion rather than strategy. Stay disciplined, stay informed, stay flexible, and build your financial life on the foundation of sound principles rather than predictions about unknowable futures. That's how wealth is protected and grown over time. Not through perfect forecasting, but through disciplined execution of sound strategies regardless of what any single month brings. Thank you for your time and your attention. I hope this analysis has provided clarity and perspective as you navigate your own financial decisions. The journey continues. Stay patient, stay prepared, and trust in the discipline that has served successful investors across generations and market cycles.